Hello, Professor. In this video, I'm gonna talk about the weekly summary too. And as you can see here, the outline is first the business level strategy, then the corporate level, and finally international strategy. And then I will go through the problem statements and finally the Capsim Round 1 analysis. So for the business level strategy, all that matters for the business level strategy is about the competitive advantage, how you want to create and maintain your competitive advantage. So any strategy you choose, it has to empower you to handle the five forces, and you have to do your best to keep your competitive advantage. So there are three generic strategies as the cost leadership, differentiation, and focus. And here in this table, as it's shown, there are two main sides for determining which strategy should be chosen. One is the size of market share, and the second is the competitive advantage. So for the broad markets, in general, we have overall cost leadership and broad differentiation. The difference is for overall cost leadership, like Walmart, uh, the competitive advantage is your low cost, but your target market is so big. But for the broad differentiation, as the market is so big, but you are not focusing on low cost, but you are focusing on differentiating your product to have higher value in the eyes of the customer. So we could talk about Apple to covering a wide market, but at the same time, it's differentiating the products. So for the narrower market, it's more about niche segments. So it could focus on the cost or focus on differentiation. But the difference is it focuses on a smaller market. So uh, what matters in a study, it has been shown that choosing more than one strategy or combining a combination of strategies outperforms the single strategies. So in this study, as it's shown here, when you combine differentiation and cost leadership together, your ROI return on investment will be 35.5%, showing going through two different strategies will contribute to outperforming other businesses. So there are two upsides to this combination strategy. First is mass customization. During the mass customization, you have the ability to produce lower number of products which are customized for specific target segment, but with the low cost because of the automation that you have, because of um, the expertise that you have had during your business. And also you will have profit pool. Profit pool means having profit in different points of your value chain in your industry. So an example, there have been many businesses that have stuck in the middle. So as you can see, stuck in the middle. A&P has been one of the biggest uh, retailers in the USA from 1920s to 2015. And in 2015, they terminated the whole business. Actually, they were using the combination of differentiation and low cost leadership, and they were the best. But in the 1950s and 60s, because of high profit, they made the mistake of sharing the whole profit among the shareholders. And in 1950s, 60s, when companies like Adler's or Walmart started, they ignored or overlooked their presence. And they were stuck in the middle of differentiating or being the cost leadership, and they didn't pay attention to the requests of people and how they have to behave with people, the salespeople. So during the time, they faded and faded. In 2015, everything was gone. So what really matters in business is that a manager should always know the life cycle of the product, market, and in the industry. And you have to know in which stage you are and what actions you have to take. For example, for a company that is in a maturity growth or industry, so the strategy, a generic strategy goes to the differentiation, overall cost leadership. So you should have differentiation, also the cost leadership, because in maturity, uh, there are many competitors, many segments, the competition is high, so you cannot have high margins. So in this situation, you have to have focus on production, and your major functional area is your production, and also the overall objective is defending your market share and extending the product life cycle. So in this situation, you have to always be careful that you are in maturity stage. You have to make uh, make new, maybe new products, or differentiating them or adding new features to them so that you can stay in the competition. So you also can have the turnaround strategies. So in some situations, you have to be flexible and you have to make some strategic changes, because if you don't do so, you will face a lot of problems and the cost will be really high. So when we go to the corporate level strategy, it's a strategy that focuses on gaining long-term revenue, long-term profit, long-term market share. So it's about seeing the future, not just the business level and having a competitive advantage. So it's all about creating value, because you have to stay in the market based on your values. The value is the only anchor that you can use to stay in the market. So corporate level strategies has two main pillars. One is value, and another is synergy. So how synergy works? Basically, we say, okay, with corporate level strategies, you go through diversification, you, for example, merge, acquire, or joint venture or whatever. And you can't expect that one business with one business will cause twice growth. So in general, they say 1 + 1 = 3, but it should equal 10, because synergy must happen. Otherwise, corporate level strategy, any type of diversification is meaningless. So in corporate level strategy, we have two diversification pillars. The first is the related diversification, which is benefiting from horizontal relationships. So we have economies of scope in a way that you leverage your core competencies, use them the most, and you will have the market power. You will have control over your supply chain. And also you will have pooled negotiating power. So you have during the through the diversification, you will have the bargaining power on your customers and also your suppliers. So in related diversification, you will have vertical integration. You can have uh, backward or forward. Forward is going through the customer and backward is going through the raw materials. Also, you have to consider transaction costs, because in diversification, you will have lots of different costs like monitoring, reporting, research, legal, and stuff like that. So an example for related is Coca-Cola. Coca-Cola decided to go into the vertical integration, but backward integration. So they decided to buy uh, some major uh, bottlers and distributors. So they did so, and they could save $350 million annually. But on the other hand, it incurred lots of operating costs, and the return on their asset decreased, and lots of operation was imposed on the company. And at the end of the day, the board of directors say, okay, in 2015, we have to shut down this backward integration because it's not logical and it's not profitable like before, and it's incurring a lot of cost on us. So for the unrelated, you benefit from vertical relationships. You go into the businesses that are not related to you. So you will have parenting advantage because you have HR, you have financial activities, and you can take control on that firm, or you can restructure the firm. You can improve the structure or change the management, change the CEO, or uh, optimize the departments. And finally, you have to take care of your portfolio management through the business growth market matrix, growth or share matrix. But before going to BCG, an example of unrelated vertical relationship is the IBM Watson. IBM created Watson as one of the most powerful supercomputers in the world. But during the time, they could shift and change the Watson's capability to being a doctor, and now they call it Dr. Watson. But who thought that IBM, that is a pure IT company, now has changed to Dr. Watson and it's using its supercomputer for medical purposes. So it's a completely unrelated and it's vertical relationship, but it has been successful. So going through the BCG matrix, as you can see, it has two sides. As the y-axis is about industry growth rate, and the x-axis is relative market share relative to the highest market share. So we have four categories: cash cow, star question, and dogs. Cash cows are products that have highest market share, but the industry growth rate is slow. But it's recommended that you keep the cash cow because it has constant profit and you can use that money for uh, injecting into other parts. For stars, stars are the best because the growth rate is the highest and uh, uh, the industry growth rate is high, and also at the same time you have high market share. So you have to do your best to keep the stars because they make a lot of profit. Questions mark are completely under question because uh, whether they have high market share or whether they have low market share, but on the other side, the industry growth rate is high or vice versa. So you have to make decision whether you want to change them to dogs or stars. But dogs, it's strongly recommended to be removed. So as an example, for uh, a brand like Samsung, mobile phones and OLED TVs are the stars, and the home appliance are the cash cows. They have a good position, high market share, but the profits are low. Question mark is the printers. The printers competition is extremely high, but industry is not growing a lot, but they are just staying in the market. And the dog is a smartphone, especially they are beaten completely by Apple, and there are lots of companies out there, they haven't been successful in the smartwatch business. Going through the means of diversification. So first we have mergers and acquisitions, and generally acquisition is always faster than building. So for example, if you want to have a license and it takes 2 years, so the best way is to buy a company that already has that license. And during merger and acquisition, you leverage the core competencies. There are sharing activities. Some assets could be shared, so the cost will be down. The cost will be spread over different products, and you will have market power. You will have control over your supply, but you will face mostly cultural issues and high premium because you have to pay a lot of money exactly in the beginning. And 50 to 75% of the mergers and acquisitions fail. So one of the successful M&As has been acquisitions have been Apple has bought Siri. So Strategic alliances. So you have cooperative relationships, you enter new markets, you reduce your cost through the value chain, but you can lose your intangible asset mostly. An example is Zara and Tata, they had an extremely successful cooperation strategic alliance, but after a while, Tata started to have its own apparel production, and now it's a competitor of Zara in India. So JV joint ventures like LNC that we had the case that they had joint ventures because it reduced the risk, and both companies have common goals and they both participate. And also the internal development, another option, it's named also corporate entrepreneurship, but one of the downsides of the internal development is it's timely. So for international strategy, we have globalization. So the main challenge is having a balance between the emerging and developed markets. In general, globalization is really prevalent these days everywhere, and many companies are in globalization situation because in a study, the companies that have undergone globalization or being multinational, they are likely to twice more likely to outperform the firms that have not undergone the globalization. So for going international, many factors should be taken into account. For example, GDP per capita. So according to World Bank, as you can see, in this part of the world, in China, India, and Vietnam, countries like that, GDP per capita is increasing. So there is a high chance for going international in those parts of the world. So for international strategy, there are some factors that affect a nation's competitiveness. So again, we have another model of Porter, Porter's diamond of national advantage. So there are four main factors. First is the firm strategy, structure, and rivalry, which is extremely important. That you have the right strategy, or does your structure allow you to be decentralized, or you have to always be centralized, and how you deal with the rivalry. The second element is the demand conditions. So whether that country is in a good economic situation, or is uh, the GDP per capita high, is the market demanding for your product, or do you need some specialization, some customization? Also related to supporting industries. How well can you deal with the supply chain? For example, if the Nike is working in Hong Kong, even in Vietnam, are the supply chains there, or again, they have to deal with import and export to China? So it really matters if you have access to the supply chain or not. And the last one is factor conditions, factor endowments, labor, capital. You have no control on them, but you have to evaluate them completely, monitor them, scrutinize, and make sure that those factors are not out of your hands. So some other factors, strategy always determines the structure. And if you want to enter a country and a government determines your strategy, for example, the low cost, you should never go in that country. And you should always have emergency suppliers. So there are, for international expansion, there are motivations and risks. For motivations, uh, if you want to expand, yeah, you can increase your market size, you will have economies of scale, you will have arbitrage, buy, produce cheaper, or buy cheaper and sell more expensive in another country, refreshing your product life cycle, optimizing the value chain activities. You have a lot of new learning opportunities in new countries, and also you can have reverse innovation and having small changes in your products and selling them to the new market. Also, you have many risks. The most important one is a political risk. China, for example. Anytime China, the government could have regulations. economic risks. So there are lots of factors that affect uh, your company's situation. The currency risk, and especially these days because of political situations, the currencies rates change, and it's really dangerous game. And you have the management risk, and for risking the managing. So for managing risk, you have two options: outsourcing and offshoring. So here's another map that shows, for example, the CPI rate, the corruption in different countries. As you can see, we have in Russia, for example, we have in China, which is less, and you have to take all of these factors into consideration for your international expansion. So you have two main factors for your choosing your international strategy, because there are two opposing pressures. One is pressure to lower your cost, another pressure for local adaptation. So when the pressure for local adaptation and lower your cost is low, you will choose international strategy. So you can have economies of scale. For example, McDonald's could have a hamburger and the same bread, the same burger. Everything is similar, and uh, there is no pressure from uh, both sides. So you can easily go and choose the international strategy. For global strategy, which is used mostly by pharmaceuticals or jet engines, actually the problem is high for you to lower your costs. So for sure, you need to have uh, economies of scale, but you will have transportation costs, you will have maybe some tariffs because you are limited to a special geographic area. But local adaptation is not high. Then we go to the transnational strategy. Transnational strategy actually pressure for local adaptation and lowering your cost is high. So a company like a giant brand like Nestle uses transnational strategies. So you have decentralized activities in your upstream, but in your downstream, which is toward the customer marketing and sales, but you are centralized toward your management, and there is the flow of information internationally, and each subsidy is in constant uh, exchange of data together, and you have a high adaptability to compete in the markets, to customize your products in the market. So for multi-domestic strategy, the pressure for lowering your cost is low, but the local adaptation pressure is high. So in this situation, you have to be careful because you have to be completely careful and attentive to how what the market wants, how the consumers want your product to be, and all of these factors help you find the right strategy. Also for entry modes, as you can see here, again, if the degree of ownership and control is low, and also we have the extent of investment and risk, both of them are low, you can go through exporting. And it's the smartest way to start in a new country. And as you go to the wholly owned subsidiary like Nestle or Toyota, the degree of ownership and control is high. And on the other hand, your investment and risk should be also high. I think this is the mistake that LNC made. And they went through the wholly owned subsidiary in a country that lots of affective factors were there. So there is a conundrum that how you can be low cost but add value. So for being low cost, you have to have the economies of scale. There are homogeneous customer needs, and nothing special will happen. And on the other side, if you want to add value, you have to differentiate. So how do they match each other? According to the studies, the demand for low cost products or uh, cheap products that have high quality is not increasing. And also for the for adding value, the main point is that today choosing a product driven strategy is no more the main subject. And now the main subject is uh, how to do like Amazon. Amazon, uh, no one can compete Amazon because the costs are low, everything is fast. But how they have differentiated, how have they added value? They have added value through making unique experiences for customers. Customer can easily, with minimum effort, give back the product anytime with no questions asked. So it's possible to be low cost and add value, and it depends on your strategy and how you want to handle it. So for problem statement, Target Canada, the principal problem with Target Canada leading to failure in 2015 was the wrong adopted differentiation strategy. They should have chosen a cost leadership strategy given the high competition in Canadian discount market. So the top five issues in order of priority incorporate wrong pricing, inconsistent product selection for the Canadians, distribution irregularities, fast growth plan from the outset, and the IT infrastructure integration. So to prevent these issues, they should have considered tough discount pricing market and lowered the prices, should have done more research on Canadian product tastes and provided right products to meet the demands, started with fewer stores to know the challenges before expanding, and should have evaluated all the supply chain probable issues like warehousing and inbound logistics, and should have researched more on how each software from different companies would integrate. For Walmart, Walmart's main problem is the ignorance of its CEO and his team to combine a low-cost leadership strategy with a differentiation strategy through e-commerce. They should have focused on environmental scanning to recognize the e-commerce trend in the early 2010s to keep up with the industry. So the current issues have been traditional mindset of retail towards e-commerce, not having enough fulfillment centers as just 20 compared to 110 for Amazon, very low number of merchants and brands, late delivery, and not enough employees for sourcing new brands and products. To solve the issues, Walmart's BOD and CEO must change their mindset that retail business is different from e-commerce and needs different strategies. Accept to invest enough on new warehouses as it's too low now. Increase their brands and merchants in a higher speed, manage the delivery problem as one of the main backlashes, and hire trained and experienced employees to manage e-commerce sourcing. So, dear Professor Ankat, I would ask you to please revise my problem statements and check if I have done a better job compared to the previous problem statement. Thank you. For Maple Leaf Foods, the Maple Leaf's problem is its outdated strategy just focusing on meat and missing the plant-based protein market trend. They should have monitored the vegan trend in North America from the early 2010s to discern the external and internal factors affecting their business to keep ahead of competitors. So the top five issues of Maple Leaf Foods are a wrong international expansion strategy adopted by the HQ in Canada to establish the biggest plant-based protein factory in the US. Insufficient research on the US plant-based industry competition, starting with no competitive advantage, dependence on raw materials exported from Canada, and currency risk. To cope with these issues, they should have chosen a joint venture or merger and acquisition in the US at the outset to mitigate the risk of failure. Have researched more on how high is the rivalry in the US. They have worked on sustainable competitive advantage to be able to compete. and have taken care of the supply chain, especially high dependence on Canada's chickpeas, and calculated how USD is always stronger than Canadian dollar and could increase the prices for Canadian consumers. So going through Capsim round one analysis. So basically, at the moment, our strategy is broad differentiator at 5 segments, being the best, having the higher, meeting all of the buying criteria at the highest points. Our structure is flat and decentralized because we have to differentiate. So our organization should be fast and we should be able to customize what the customers want as soon as possible. So we need a professional and fast and agile organization. So we have to be flat and decentralized. In general, we sacrificed our short-term profit for market share because we believe that market share in the long term means trust. So after several rounds, if we have the highest market share, so for sure we are the most trustworthy brand and we can do a lot better and outperform other brands. Also, we want to make the entry hard for new competitors. So we want to, in general, invest on HR, training hours, TQM, and also increasing automation, and in general, meeting all the customer demands and lower the cost as high as possible so that not many brands can compete with us. And also, you want to invest in cash cow. Cash cow in round one is our low end product, which has the highest market share, but the profits is low. But we are sure that in the long run, it will help us invest the cash cow profit in other projects. So here is what we have considered for our brand. So in the beginning, we will have minus profits, which we had, and then in the growth stage, we will have profits. But also we will take care of these parts, so we have to be careful to have differentiation so that we can stay ahead of the competition, not going into the decline stage. So the perceptual maps. In the traditional segment, it's the most in dense market segment, and mostly, as you can see, C and D have 18% market share, and we have 17. And mostly the accessibility and the awareness are almost like each other, but C and D are doing a little better, but in general, D is outperforming a little in terms of accessibility and awareness. So you have to be careful, but we take this opportunity because E is weak. So, and also F is weak. So we want to be more aggressive to have some share of these two. For the low end, we have 24% market share. We have the highest awareness, and but the accessibility is almost during the top. But the second highest market share is for D and A, which are 18%, and C is 10%. So again, E and F are not part of this game, and somehow C. So again, we will take this advantage to, regardless of profit, we will try to increase our market share by several percent. Going to the high end, it seems that from the very beginning, we are staying ahead. But in terms of awareness and accessibility, but D is doing better in terms of market share. But again, we will take the chance for Echo, Adam, and Feast that are not part of this segment. But the game is different here. In performance, 4 brands are not doing well. So now it's a golden time to get as much as market share, increase the awareness, increase the accessibility, and at the same time keep all the buying criteria. And also, not now, but in 2 or 3 rounds ahead, we might add some new products. And the game again is different here in the size segment. And we are at the top, we have 20% market share, highest accessibility and awareness. So mistakes we made the wrong traditional production number, which led us to, unfortunately, emergency loan. So how we did here, as it's shown. So unfortunately, we went through 15 million emergency loan, which was mostly because of our inventory. Our sales was really brilliant, 150 million, the highest sales possible. But the other, the EBIT, our profits, cumulative, are negative. And also our contribution margin should be more than 30% according to Capsim, but it's 21.9. But as we are increasing automation and we are spending on HR, hopefully, and also decreasing the second shift in some segments, hopefully we will take care of that. And also going through, and in general, we have 21% whole industry's market share. Unfortunately, because of our negative profit, our loss, actually, our stock price fell down. And now our credit situation is not good at all. We are C. And there are 2 parts here that are important to be taken care of. So actually, first, here our inventory, 20 million inventory. And unfortunately, our net cash from operations is not good at all. It's minus 20. Planned improvement, we will spend as much as possible getting the long-term loan and spending in our planned improvements. And we will continue this process. And also here, as it's seen, we have current debt is 15 million. And again here, our sales 150 million. So our main focus is decreasing the variable cost, which we will, because we are doing everything necessary for decreasing labor costs, material costs, increasing automation. And for contribution margin is 32 million, not bad, a little less than C. And then depreciation is like the others. We will spend as much as possible, as much as required to reach 100% awareness and accessibility as soon as possible, because we believe that marketing and sales play a vital role. And that's it here. And then going down through, the problem is here in our inventory, that here for B, actually we attack the market in all segments. So as you saw in the perceptual maps, we did the best, but the only problem was Baker, because we didn't know how competitors are behaving, but the competition was extremely high. So the ideal age, ideal position, MTBF, uh, spending on awareness, spending on accessibility, everything was high. Revision dates. So all the competitors were so close. And actually, we planned for 30% of the market for all of the segments, regardless of any competition. And it worked for the other four segments because always there are some competitors that choose to do better in other segments. So actually, we sacrificed uh, this loss and a lot of money for getting the market share. And we were not that successful, as much successful as the other segments, but we will take care of this part. And also the other, everything is clear here except the traditional that the B, the Baldwin, except this one, that we hope that we can do well in other segments. You can see that B is number one in, this is our cash cow product. So here in high end, here in performance, here in size. So we will try to keep the broad differentiation strategy. So that we can keep ahead of our competitors based on the market share. And that's it. Thank you, Professor. I hope that I can do a lot better the upcoming rounds.